Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us, giving us a few minutes of your time. The two topics we got to talk to you about today, we're going to talk about the yield curve, which is on the precipice of another change, and we'll talk about what that might mean. And Andrew's going to take a look at earnings results and forecasts and what we've seen from this third quarter worth of earnings. So let's talk about the yield curve coming up. So just so we're on the same page here, I'm sure you hear that term. It sounds really fancy, but what we're talking about the yield curve is simply the shape of interest rates over various time frames. So at various points, you're going to have different rate differentials based on how long of a term the notes are. And so here we're just going to be talking about the U.S. Treasury. So in that case, the Treasury is always issuing 3-month notes that are always maturing every 3 months. They've got the 2-year bond, and of course, they've got 10 and 30. And there's others across different maturities, but we'll focus in on those two. And there's really two primary yield curves that people will use to talk about. One is the 10-year versus the 2-year. And the other is going to be the 3-month versus the 10-year. So in this case, we're going to be talking about the 3-month versus the 10. On the 2 versus 10, it has already changed. See, we spent most of 2022 to 2020, in the middle part of 2024, with the short-term rates, whether it's 3 months or 2 months higher than the 10-year part of the curve. That's what we call an inverted yield curve. Normally, you get a higher rate of interest for the longer you go out, but that has been flipped on its head for most of the past couple of years. And we're knocking on the door for that flipping on the 3-month versus the 10-year. Now, why that's important is historically, inverted yield curves have always led to recessions. That does not mean that they always will, but in the past, we're looking here in the modern era, but since 1960, each of those instances have produced recessions. And these are notated here by the vertical gray lines. Those little red shaded line pieces of the line chart, that's where the yield curve has been inverted or negative. When it's green, that is your normal, that's a healthy environment. But typically that recession happens after we uninvert. So we are hitting that point in time. Again, I say that doesn't mean that the future will always look like the past. If anything else, what we could say about this environment has been unique in so many different ways. And there's always the chance that you have an outlier in history, but it's something that we have to be in tune with. There are economic reasons on why this is held. So it is certainly noteworthy and something that we have to keep in mind. But we certainly do have that flipping for the time being, or at least on the verge of flipping. So Andrew, that's the yield curve. I'll flip it over to you to talk about the earnings outlook.
All right, thanks, Adam. So we've pretty much had about just over 70% of all S&P 500 companies report earnings. We have one big one coming next week, but with the majority of them having not reported, we can start looking at what was the general consensus or improvement in growth for most of the companies in the third quarter. And so I have two charts that I want to show you today. The first one on the left is looking at earnings surprises. So all the big Wall Street banks, for each company, they put out expectations that we think Amazon, Apple, Walmart, Kmart, Target, that's not a company anymore. All these companies that will report certain amount of earnings, and then the companies report, and then we can evaluate, was Wall Street right or wrong? Were these companies exceeding expectations or underperforming what Wall Street was expecting of them? And so that's what this first chart's looking at, is how many of them beat those expectations and how many of them missed. And for the Q3, there really wasn't a lot of big surprises. You can see about 51% of companies beat and 15% missed. And that's right along the historical average of 49 beating and 13% missing. So Q3 was pretty much in line with what a lot of the Wall Street banks were expecting. Now, the chart I think is a little bit more interesting and probably more impactful as we now turn to the chart on the right. This is looking at expectations going forward. So this is where banks have consensus for where they think earnings per share growth is going to be for three different groups of stocks. The first one is the S&P 500 is expecting actually not a lot of growth in 2025. It's flat. When we look at just the S&P, the Mag 7, a group that we talk quite a bit about in the market carver, those mega cap stocks, Apple, Microsoft, Google, Nvidia, these huge behemoth companies, that's where they're seeing a lot of the growth is expected to come from these 7 names. In fact, 17% change in the consensus for earnings per share. Meanwhile, all the other stocks, the 493, actually have declined in the consensus. They're dropping 3%. So again, this is initially suggesting in what will change as far as the actual earnings. This is the change in the consensus, the change from over the last year of what banks are expecting. And they continue to raise the bar for those mega cap stocks, and the bar is actually going down for the rest of the market. And so this puts a lot of emphasis, a lot of focus again on these stocks that have so far have been performing very well in meeting these expectations. And as we go into 2025, the bar continues to be very high for these mega cap growth type names. And meanwhile, a lot of the other companies that still are producing great earnings, great growth, the bar has been lowered for them. Some will say that as a positive sign, the fact that it's much easier to get over a lower bar, but the market continues to be very focused on the Mag 7 from both a asset appreciation perspective as they continue to grow at astronomical rates, but then also from an earnings perspective, looking at the fundamentals where they're expecting to continue to generate very high levels of gains. So it's something we'll be watching for in 2025.
Yeah, and I do apologize to all of you who are listening, and I'm sure that you had me dropping Kmart instead of Andrew on your bingo card. But alas, we need to get some of your charts updated if that's tip of tongue. That's been a while. But I know all too easy how that happens. But and nevertheless, well, we do sure appreciate you giving us some time. As always, if we can be of service, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks so much and have a great weekend.